Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and in this video we are debriefing the section A of the FM pre-December 2024 mock exam. So there are 15 questions in section A of your exam. We will step by step discuss all of these questions. Let's get started. The first question says, Cosmos Company is exploring a new project with a lifespan of 4 years. The project promises robust returns of a positive net present value or the NPV of $400,000 when discounted at an annual rate of 10%. These estimations are based on expected cash inflows of 500,000 annually over the project's duration. Tax is payable 1 year in arrears at the rate of 30%. So the requirement says what is the change in the annual cash inflows which will make the NPV zero. So this is very simple. Whenever you're talking about how much change will make something zero, you're basically seeing how sensitive that is. So we are required to calculate the sensitivity over here. So for doing that, we are going to take the NPV in the numerator. NPV is given to us. NPV is given to be $400,000 when discounted at an annual rate of 10%, and the expected inflows are 500,000 over the duration of the project. So how are we going to find out? We will first see how much is the NPV. NPV is already given to us as 400,000. Now this needs to be divided by the present value of your after tax annual cash inflows. So first of all, you will be getting 500,000 every year. So we can have a look at the formula sheet. This is basically going to be an annuity that you're getting. So this is going to be an annuity. We'll move to the annuity tables. 10%, and this is something which you are going to be getting for a period of 4 years, right? So this is a project of 4 years. Have a look here. 4 years, 10%, it is 3.170. That means the present value of these cash flows that you will be getting is 500,000 multiplied by 3.17. This is what is the money that you're getting at the moment. Now, the next thing that you need to consider is that you will be paying tax on this. Tax will be 30%, and this is paid 1 year later. So 500,000, 30%, and that will be multiplied by the annuity factor. Now let's have a look at the table. We are looking at the rate that is there for 10%. So what we are going to do over here is, so this is going to be an example of a delayed annuity. The last cash flow, because the project is for 4 years and we are paying 1 year later, 1 year in arrears. So the last cash flow will be in year 5. That means we are going to be picking 3.791. But we will not be able to straight away take this because there is no cash flow that is happening in year 1. First year's tax is going to be paid in year 2. So what do we do to take the discount factor is that we will take, let's note this figure down on the scratch pad, 158,500. Then we are going to take the difference between these two factors, which we have just noted down, 3.791 minus 0.909, 3.791 minus 0.909. And this is the factor which we will be using to find out the present value of the tax that we are going to be paying. So this is the factor that we get, and the tax amounts to 30%. So this will be multiplied with 30% of the cash flow, which is 500,000. So this is the total present value of your taxation amount. Earlier, what we had written was 158,500. So from this, we need to take away 4,323,00. So this is what we are going to work out here. 158,500 minus 4 32300. So this gives you the figure which you are going to take. So the present value of inflows over here is going to be 500,000 multiplied by 3.17. Let's have a look here. Let's redo the calculation. 500,000 multiplied by 3.17. And from this, you need to take away, this is 185. Okay, these are three zeros. That's why we were getting a difference. From this, we need to subtract 432300. Yeah, so now we are getting the correct answer of the PV of inflows. Now, the sensitivity formula is in your numerator, you're supposed to take the NPV. Denominator is supposed to be the PV of inflows. I'll write the answer here, 1152700. So NPV is 400,000 given to us. This will be divided by 1152700, and this you get 0.3470. And if you multiply this with 100, you'll get your answer in a percentage as 34.7%. So you choose this and you move ahead. This is the second question in front of you now. Tech company, a successful software company seeking to diversify into the hospitality industry amidst the market saturation in their current sector. Tech company aims to ascertain its cost of equity for evaluating the new investment proposal. Sunshine Company is a listed company in the hospitality industry. Existing capital structure and equity beta of the two companies are as follows. Assume that there is no corporation tax. Risk-free rate is 3% and market risk premium is 5%. Should tech company plan to adopt its existing capital structure for the new investment proposal, determine the revised cost of equity for tech company in the hospitality structure, rounded to the nearest whole number. So what we are going to have to do over here is, firstly, we need to find out how much will be the asset beta of this Sunshine Company. So of the Sunshine Company, we are given that their equity beta is given to us as 2. So how do you find out the asset beta? The formula is given in the formula sheet also. You can refer to this. So this is the asset beta formula. Beta asset equals to value of equity divided by value of equity plus value of debt into 1 minus tax multiplied by beta equity. So we are supposed to find out the beta asset over here. This all because beta debt is 0. So this is assumed to be 0. So what do we take over here is that beta asset is what we will find out. Beta equity is given to us as 2. This will be multiplied with, firstly, in your numerator, you had the value of equity. So the value of equity in this case is going to be, specifically if we talk about for Sunshine Company, the debt to equity ratio is given to us as 2:3. So 3 is the value of their equity. 3 divided by, then further in the denominator, you have value of equity plus value of debt into 1 minus tax rate. So 1 minus tax, because tax rate is 0, so it gets multiplied by 1. There is no point to write about that. So we will simply take 2 because 2 is the debt proportion that is there in their capital structure. So I input 2 over here and I solve this. This gives me 1.2 as the beta asset. Now what I need to do is I need to gear it again for tech company using their debt to equity ratio. So their debt to equity ratio is given to us as 1:2. So 1.2 needs to be multiplied with, again, taking the value of equity plus the value of debt into 1 minus tax divided by value of equity. So value of equity over here is 2 and the value of debt is 1. So 2 plus 1 gives us 3. This will be divided by 3 is the value of their, 2 is the value that we will have for their equity. And so the denominator, let's do it from scratch. 1.2 is what we have, right? 1.2 is what we have. This needs to be multiplied with the total of value of equity plus value of debt into 1 minus t. So value of equity is 2 and value of debt is 1. So 2 plus 1 is 3. 3 will be divided by only the value of equity. Value of equity is 2. So 3 divided by 2. So this gives you 1.8 as the geared or the equity beta for tech company. Now you need to find out the cost of equity. Cost of equity is the risk-free rate plus the beta multiplied by risk premium. So beta is 1.5, premium is 5% into 5. This gives you 9. 9 plus 3 gives you 12%. So we will write 12 as our answer. Moving ahead. Next up, Bubblegum Company has 12% convertible loan notes outstanding, maturing in 5 years' time, and to be redeemed at a face value of $100 per loan note. Alternatively, each loan note can be converted into 40 ordinary shares with a nominal value of $1 after the 5-year period. The company's shares are presently trading at $2 each, projected to grow at an annual rate of 5%. Bubblegum companies pre-tax cost of debt is 10%. After tax cost is 7%. So you are required to find out the current market value of each loan note rounded to the nearest dollar. So as we know, whenever it's a redeemable loan note, because it is convertible, either you have the option to redeem or you have the option to convert. So it's a redeemable loan note. So market value of these redeemable loan notes is the present value of their cash flows. So we will find out the difference of whether the shareholders will be going ahead with, the loan note holders will be going ahead with the normal redemption, or will they be converting it to get a greater benefit. So let's have a look over here. So the loan note holders are going to have two options. Either they can convert it into 40 shares, or they can get at the face value of $100 per loan note. So let's find out how much will be the conversion value. It's given that presently the share is of $2 each, and it is growing at an annual rate of 5%. So this redemption is going to be after 5 years of time. So let's see how much one share will be worth after 5 years. 2 is the price right now, and every year it is growing by 5%. That means this will be multiplied by 1.05. 5 is the growth rate, 5%. So it is $2 at the moment. $2 multiplied by 5% growth rate, 1.05, and this 5% of growth rate needs to be raised to the power of the number of years, which are also 5. So this gives you the value of one share 5 years from now. And how many shares are you giving per loan note? It's 40 shares. So 40 multiplied by the value of one share gives you 102.10. So if you are given the option, do you want $100 or do you want 102? Obviously, the investors are going to choose the higher value. So let's include this and find out the present value of the cash flows now. So this is the value that you are getting at the very end. So at the very end, you're going to be considering this is the amount of money which you will be receiving, and now you need to multiply it with the present value factor. So the cost of capital which we are going to use, so from the perspective of investors, it's always going to be that discount rate which is the pre-tax cost of debt. Why are we taking the pre-tax one? Because it is not the holders, it is not the loan note investors who get the tax benefit, it is the company who gets the benefit. So whenever you're considering it from the perspective of the debt holders, because they are the ones who are buying and selling it in the market, they are going to be using the pre-tax cost of debt, which is 10%. So 10% after 5 years is 0.621. So this figure will further be multiplied with 0.621. This is the final value which we will be getting at the end, but we also need to add for the interest that will be given every year. So let me note this down here. This is 63 point, my apologies, 63.41 roughly. And now I will account for the interest that we are getting annually. So annually, it is a repetitive payment, so it becomes an annuity. You go to the annuity tables, 10% is the rate of interest, and for 5 years, we are getting this cash flow. So this is 3.791. So 12 is the interest that we will be getting because these are 12% loan notes. Nominal value is 100. 12% of 100 is 12 itself. So 12 needs to be multiplied with 3.791, which is going to give you 45.492. To this, you need to add what we had calculated earlier as the redemption value, 63.41. So 63.41. This combined gives you 108.902, which is the closest to 109. So this is what we select. Moving ahead to the question number 4 now. The NPV of a lease agreement calculated at a 10% discount rate yields a negative of 21,003. The lease terms of the lease involve an immediate down payment of $10,000 followed by 4 equal annual payments, with the first payment commencing at the end of the first year. What is the amount of equal annual lease payment for the 4 years closest to? So how do we find out? This is going to be basically, we are going to consider present value of the lease agreement is going to be the sum of your down payment and the present value of the installments. So down payment is given to us as $10,000, plus if we add to that the first installment multiplied by the annuity factor. Let's have a look at the annuity factor, 10%, and we want it for a time period of 4 years. Annuity factor, this is the annuity table. 10% for a period of 4 years, it is 3.17. So the installment multiplied by 3.17 is what we have. I'll put it on the scratch pad to make it simple. See, the PV of the NPV that we are getting of the lease agreement, this is going to take into account what we have as the initial down payment, which is $10,000, plus what we have taken as the uh, lease payment amount multiplied by the annuity factor which we just saw as 3.170. So this will give you an equal sum to minus 21,003. So this is what the equation looks like. Now you need to find out the lease payment. So what you're going to do is you're going to take this 10,000 to this side. So lease payment into 3.170 will give you a negative of 11,003. So L into lease payment into 3.170 is going to give you a negative of 11,003. And with this, so basically, if you know, we are subtracting the payment, right? So if in negative it is there, on this side also, it's going to get added. So the inverse happens. This is the bigger figure. So after adding 10,000 here, we are left with 11,003 in negative. Then you need to find out L. So simply LP will be equals to 11,003 divided by 3.170, which is going to give you 3471. So this is your final answer. Moving ahead to the next question now. Question number 5 says, indicate by clicking on the relevant boxes which of the following statements are true or false in relation to working capital. So the first statement says the two primary objectives of working capital management are to balance between profitability and liquidity preference. This is absolutely true. This is what we have studied. Invoice discounting is usually performed on the entire receivables ledger. No, that is not the case. Invoice discounting you usually do whenever there's a need. You do not always do that for entire receivables ledger. Aggressive approach to working capital financing can increase profitability. This is absolutely true. What we do in the aggressive approach is that we keep lesser and lesser money with us. That means we are investing more and more money, and investments give us profits. Then the last statement says a disclosed factoring agreement will be an advantage to the seller in upholding its business reputation. So this statement is false because when you are having a factoring arrangement and if they are upholding, if they are actually having that, if you are disclosing the factoring arrangement, basically that means that you are letting your customer know that I have hired some other party to collect money from you, and I'm taking your money in advance from that party. So this really shows that you are not good at managing your working capital. That is why you have to do this. So a lot of businesses usually keep it confidential that they are having any factoring arrangements in place. Moving ahead to the sixth question, Snow Company intends to initiate a 1 for 3 rights issue offering shares at a 20% discount to the current market price. Presently, the company's earnings per share EPS stands at $2, with shares trading at an earning yield of 5%. Additionally, Snow Company's market capitalization is valued at $240 million. You are supposed to find out the TERP in this scenario. So the current share price, if I want to find out, the EPS is 2. EPS is nothing but earnings per share. So earnings divided by number of shares gives me $2, while earning yield is given to me as 5%. Earning yield is nothing but the inverse of the EPS ratio. So if I take $2, divide that by 5%, I will get my current value of the share. So I have $2 $2 divided by 5%, which will give me 40 as the current share price. Now, as per the rights issue, we are offering at a 20% discount. So 40 multiplied by 0.8 is what we are charging. So we are charging 32 as the rights issue price. Now let's see how many shares are we issuing. We are going for a 1 to 3 rights issue, and the market cap is also given to us. If the current share price is 40 and you have 240 as the market cap is nothing but the number of shares multiplied by the value per share. If the value is 40 and the total market cap is 240, that means the number of shares is 240 divided by 40, which gives you 6. 6 divided by how many, what is the ratio? So 1 for 3. 6 multiplied by 1 divided by 3. So 6 by 3 gives you 2. That means you are issuing 2 million shares as a part of this rights issue. Now the TERP, what you take in the numerator is always the product of the current price multiplied by how many shares you have in issue right now. Right now you have 6 million shares in issue. So your numerator is going to look something like this: 6 million shares multiplied by 40 plus what you are issuing right now at $32, you are issuing 2 million number of shares. So this in totality is your numerator, 240, 40 multiplied by 6 plus 32 multiplied by 2. This is what your numerator is going to look like. And this needs to be divided by the total number of shares. Earlier you had 6 million shares. And now with the rights issue, you are issuing 2 million shares. So the total becomes 8 million shares. So 304 divided by 8 million will give you your final answer. TERP is $38 per share. So with this, you will write 38 over here. Now we are through with question number 6. Let's head ahead. Question number 7 says, which two of the following statements regarding financial markets and economic policies are correct? Higher taxation is expected to boost overall demand within the economy. Now, this is wrong. The reason, because if the people end up paying higher taxes, that means they're left with lesser money in their hands, which is also known as disposable income. So people have lesser money to spend. So definitely it's not going to boost the demand in the economy. Second statement says supply side policies will lead to raising the capacity of the economy in producing more goods and services. Now, this is absolutely correct. Supply side policies means where you're actually focusing on your manufacturer's capacity to be able to produce. So, if you create policies like that, you're obviously going to raise the capacity of the economy in their ability to produce more of goods and services. The second statement is one of our answers. Third one says maximizing market share is an example of corporate's financial objective. Now, this is not a financial objective. If you talk about increasing profits, that is something which is known as a financial objective. Market share is not a part of your financial objective. Last statement says peer to peer allows people to lend money directly to small businesses without going through a formal financial institution. This is exactly what we have studied in the concepts. Peer to peer means friend to friend. So there is no formality involved over here. People form a group and then they pool their resources together, and whoever requires the funds, they are given with the funds at a lower price, lower interest rate. Moving ahead to question number 8. Which of the following statements regarding value for money are correct? First one, acquiring resources at the lowest cost. This is, we're talking about economy, so this is correct. Second says implementing innovative marketing campaigns. This is not a part of value for money. Maximizing shareholders' dividends, again, not a part of value for money. Fourth says ensuring maximum output with the given resources. So here you're talking about nothing but efficiency. So 1 and 4 is your answer here. Moving ahead, in a booming stock market, investors observe rapid price fluctuations following the release of listed companies' annual reports. The form of efficiency is what we need to select over here. So, this means if you analyze the statement, rapid price fluctuations can be seen after some information has been released. So, that means after the news was released, then the information is being reflected. So this means that this is semi-strong because that is where all publicly available information is reflected. In weak form, it only represents past data, and under strong form, it will reflect, public as well as unpublished information. But here, because this is release of the reports, so this is going to be a semi-strong form efficient. Moving to question number 10. Purple Company, which is about to pay a dividend, typically offers a dividend yield of 10% based on its ex-dividend share price. Current market price of its shares is $55 come dividend, and the company has 2 million shares in issue. Purple Company adopts a dividend payout ratio of 20% and has a 15% return on its equity. Now, we are required to find out the cost of equity for Purple Company. So cost of equity, we are going to be using the DVM formula, dividend multiplied by 1 plus growth rate, divided by what you have as the share price. This is what we will use. Now let's see what all working will we have to do. 55 is the share price that is given to us, cumulative dividend. That means the dividend is also included in it. Dividend yield is 10%. So if we find out how much is the dividend, we can do that using 55, we can say is 110, and I want to find out how much is 100. So if 55 is 110, so 55 divided by 110, and I want to find out how much is 100. So I will multiply this by 100. That means presently my share price is 50 and dividend that is going to be paid is 5, which makes 55 as the cumulative share price. So it all adds up. Then the next thing that is given to us is the retention ratio. See, have a look here. They have a dividend payout ratio of 20%. So that means if they are earning 100, they are giving away 20. That means 80 is what remains with them. So the Gordon's growth model, according to that, you're going to find out how much will be the growth rate. So the growth rate has got to be, again, having a look at the information, growth rate is going to be the return of equity multiplied by your retention ratio. If they are paying out 20, that means they are retaining 80. So 80 multiplied by 15%. It's going to be 80%, or we can say 0.8 multiplied by 0.15. So this is what we get as the growth rate. 12% is my growth rate. Now I will use the DVM formula to find out my cost of equity. As a part of my numerator, I'm supposed to take the share price, which is, I'm supposed to take D1. So dividend right now is 5. and this will be multiplied by 1 plus growth rate. Growth rate I just calculated as 12%. So this is going to be my numerator. This needs to be divided by my current share price. Current share price is 50. And to this now I need to add the growth rate. So I will add the growth rate 0.12 over here, which is going to mean it's 23.2%. With this, we are through with question number 10. Let's head to question number 11 now. Question 11 says Cyprus Company's management has an annual credit sales totaling $50 million with accounts receivable amounting to $10 million. Working capital is funded through an overdraft at an annual interest rate of 10%. Company's cost of capital is given to be 13%. Assuming 365 days in a year, what would be the yearly reduction in finance costs if the management shortens the collection period by 40 days? So the first thing that we need to find out is how much is the how much is the receiving time right now. So we presently have 10 millions of receivables on a total sales of 50. So 10 by 50, and this needs to be multiplied with 365 to find out the number of days. So this gives me 73 days. That means presently I am taking 73 days to collect my receivables. If I reduce this by 40, it is going to become 33 days. So if I find out how much will be my receivables now, 33 divided by 365 multiplied by how much my sales is, which is 50 million. So now my receivables will become 4.52 million. Now, if this is my receivables, earlier my receivables were 10 million. So from this, if I subtract 10 million, I get this as the reduction in my receivables. Now on this, I'm going to save a total of 10% because that is my overdraft cost, which gives me my answer as this one over here. Moving ahead, Company a manufacturing entity, find itself in a need of $4 million of loan for a 6-month period, which it requires in 3 months' time to facilitate its expansion initiative. To mitigate potential risks stemming from the interest rate fluctuations, Company A is considering two forward rate agreements that are offered by the bank by another bank by the quotation of. So there are 3 to 6 and 3 to 9. So now have a look at the requirement. We require a loan after 3 months, which we want for 6 months. So it should start after 3 and it should continue till 3 plus 6, which gives you 9. That means we are going to have to go ahead with the second option. Should the loan interest rate on the date when loan is taken up is 10%, what is the payment or receipt Company A will make or receive with the FRA bank? So have a look here. We have established that we are going to choose the second agreement, which is going to be suitable for us. So if we have chosen the rate to be 12% and the actual interest rate is going to be 10%. That means we have paid the bank less and we need to pay the bank more. How much more we need to pay? The difference is 12 minus 10, which is 2%. 2% is there on an amount of 4 million. Let's use the calculator. 2% is 0.02 is there on an amount of 4 million, and this is for a period of 6 months. So again, it needs to be multiplied with 6 by 12. So you get 40,000 and A is going to pay the bank $40,000 because we have paid them less. The rate that was agreed, that was fixed, was more. So we will be paying the difference to the bank. Question 13 says, indicate by clicking on the relevant boxes in the table below whether each of the following instruments that are commonly in use by organizations are of short-term or long-term financing. Commercial paper is always short-term, lesser than a year. Preference share capital will be for the long-term. Treasury bills are considered as short-term, and so is bankers' acceptance. Moving ahead to question number 14. Which of the following statements accurately describes the differences between the traditional theory and the M&M theory regarding capital structure? So let's have a read at the statements. First statement says traditional theory assumes cost of capital remains constant regardless of the capital structure, while the M&M theory suggests that the cost of capital increases with higher levels of debt due to financial risk. Now, this statement over here is incorrect. It is rather the traditional theory which tells you that you need to minimize the cost of capital through the optimal structure. It does not say that it remains constant. So the first statement gets eliminated. Second statement says the traditional theory asserts that the value of the firm is unaffected. However, this is not the case. According to the traditional theory, it says that you can minimize your weighted average cost of capital, which will maximize the value of the company. Then the third one says the traditional theory emphasizes the importance of minimizing the weighted average cost of capital. This is absolutely correct till here. Let's read further through optimal capital structure decisions. While the M&M theory argues that the capital structure decisions are irrelevant to WACC in a perfect capital market, perfect capital market means where there are no taxes. And as we have studied, M&M without tax says that the WACC does not influence your capital structure. So this statement is correct. Let's have a read at the last one also. Traditional theory advocates for maintaining a balance of debt and equity to maximize the wealth of the shareholders, while the M&M theory suggests that the firm should minimize financial risk by avoiding debt altogether. This is wrong. M&M theory says you should take as much debt as it is possible. Now, moving towards the very last question of your section A, current euro US dollar exchange rate is given to be $2 for 1 euro. ABC company, a Eurozone company, makes $1,000 sales to a customer on credit. By the time the customer pays, the euro has strengthened by 20%. So, what will be the euro receipt over here? That is what we need to find out. Now, the scenario tells you that the euro has strengthened. So, if euro has strengthened, that means you will be needing more dollars to buy the same 1 euro. So, how many dollars will you now need? $2 is what was the rate earlier. $2, now you need 20% more. So 2 multiplied by 1.2 will give you 2.4. Now 1 euro you will be able to get by giving $2.4. Now there was going to be a receipt of $1,000. So $1,000 and 2.4 is what is getting you 1 euro. So 1,000 divided by 2.4, 1,000 divided by 2.4 will give you your receipt, which is going to be 416.67 euros. With this, we have come to an end to the section A questions from your FM pre-December 2024 mock exam. Do let me know in case you have any queries or if there was any part that was unclear to you. And I hope that these videos have been useful for you in your preparation. Also, let me know if you want me to debrief the section C of the exam. And I wish you all the very best for your exam. May you clear the exam with flying colors.